Hi everyone, welcome to today's class. Today we're going to see Asset Liability Management in Banks Unit 5. Okay, the first topic is Transfer Pricing. Okay, so what it means, it is a measures that contribution of each source of funding overall the profitability in financial institutions. Okay, so funds that go towards lending products are changed to assets generating business, whereas funds generated by deposit and other funding products are created in a liability generating businesses. So by this the FTP, okay, fund transfer pricing, mainly known as, it is the system used to estimate how funding is adding to overall profitability of the company. So this sees it as it is its most significant use in the business banking, okay, banking industry, where financial institutions use FTP as a way to analyze the strengths and failing weakness of the firm within the institutions. So this FTP may also help determining profitability of various product lines, okay, the bank office. So the performance of branch outlets and judge the effectiveness of a processes. So note, this FTP is different from transfer pricing. Okay, so an account practice that represent that implies prices that one division in a company charges another division of goods and services. So these are FTP is a method used to measure how funding is contributed in overall profitability of the firm. It's just a totally, okay. So then most global regulators have not incorporated FTP analysis into comprehensive bank regulatory reporting. So which remains an important metric for a internal analysis with several regulatory guidelines provided by the industry best practices. So the single rate and multiple rate methods provide two basic system of a internal FTP. Okay, there are two basic system, single rate and multi rate. So then FTP methods, okay, so it is an important reporting metric used in a banking management analysis, okay. So on reporting, so which requires to the pooling of information across assets and liabilities. So commonly it is also analyzed in conjunction with asset and liability management, so which additionally it may evaluate alongside other metrics such as net income, net interest margin, like that. Okay, so there are a variety of methodologies for FTP used in a banking industry. So two of the most basic methods include single rate and multi rate. By this, the single rate means which provide comprehensive view of assets versus liabilities by maturity. Okay, so with the single rate method, all assets and liabilities are assigned in a single transfer rate, so regardless of the nature of the products. Then multi-rate method means which breaks assets and liabilities into additional groups based on the selected characteristics. So within the multi-rate method, the management has a more granular view of risk. So the multi-rate methodology is often for product and maturity breakouts. So in this breakout, some of the more granular details of the consideration, which may also include the funding liquidity spread, so contingent liquidity spread, the credit spread, and the option spread, and the basic spread. Okay, and the next one is charting fund transfer pricing. So this is charting is a part of methodologies. So with the charts represent the pooled data of across assets and liabilities. So in general, it charts the association between yield to maturity or time to maturity. Okay, so this charting can be customized based on the methodology and report requirements. So internally, the financial institutions will have an interface that include all of the high level FTP metrics that are following. Okay, the charting fund transfer the methods which we're going to see. The first one is a real world example. So example means, so many bank use FTP charting to analyze funding by location. So in this example, the bank management would use FTP to determine profitability of funds at individual divisions. The analysis takes into action, so the deposits of each brings the amount provided that as loans, so as well as the number of contributions the customers the location services. If a particular arm is continuously underperforming established baseline, okay, so if it is baseline, the reporting significant declines, then it can lead to branch closure decision. So if a branch closes it, it will typically transfer accounts and resources to another nearby location. So since 2018, the financial crisis, the government Dodd-Frank Act has primarily focused on increasingly the regulatory level of liquid capitals. So to help the reduce risk across the largest banks. So this fund transfer pricing analysis has gained increased attention by managers as well as but guidance has been more informally introduced rather than the mandated. So, according to the Moody's Act, as of 2019, some of the leading regulatory precedents for fund transfer pricing (FTP). Okay, so the best practices includes those credited by the United States. So, which is Federal Reserve, SR 163 letter. Okay, the next one, FTP rate in banking. So how the banking will be fixed in FTP rate. So fund transfer pricing is a system which is used to estimate how funding is adding to overall profitability of the company. So this sees its most different significant use in banking industry, where financial institutions use FTP as a way to analyze the strengths and failures of the firms within the institutions. So which is a process used in a banking to measure the performance of a different business unit of banks. Excuse me. So by this is a process used in a banking to measure the performance of different business units of a bank. So like other top business schools, the institute carries out a great deal of teaching research in all aspects of banking and finance. So one of our greatest experts in the field is Professor Jean Derman, okay, who has advised central banks, commercial banks and international organizations. In the following interview, he presents his views. Okay. The next one, what exactly is fund transfer pricing? What exactly? We have to know what exactly it is. So it is a method used by the bankers to evaluate the profitability of deposits and loans. So the challenges in the case of the former as follown. When bankers evaluate the profitability of deposits, okay, so by this they know the cost, the interest to be paid on those deposits and associated operating expenses such as employee time and IT. So, however, determining the return is more problematic because the deposits are used to finance various types of assets, which is such as consumer loans, corporate loans, interbank assets, bonds, fixed assets like that. So, an identification of the revenue known as a fund transfer pricing, which must be made. So, by this, in fact, it is absolutely essential for a accurate pricing of the bank's commercial products. So, not to mention performance evaluation of organizational strategy to have a sound method of calculating fund transfer pricing. And for next, the importance, okay, so and for loans, actually for loans I didn't say it. So for loans the problem is symmetrical, okay, so the bankers know the return of loans, that is the interest income, so net of the expenses incurred by bad debts, so but not its funding cost. So the reason in the case is that bank use several sources of funds to finance assets, so such as a demand deposit, saving deposit, time deposit, corporate deposits, interbank deposits. So the subordinate debt and equity, again they need a specific fund transfer to evaluate the cost of funding loans. So then the importance means it is particularly important to the light of the recent global banking crisis. So and the ongoing economic turbulence in a eurozone. So which is added to that implementation of Basel 3. Okay, the round of banking regulations will place an added pressure on a banks to maintain a buffer of liquidity. So based on this, under this, the first one, central funding unit concept. So which means this FTP has become important because banks are expected to state their funding cost accurately as a regulatory requirements, because funding cost affects the bank liquidity reporting. So in failure and bailouts of the banks have made reported liquidity of hot topic. So this calculation is complicated by several factors which make the calculations of a revenue adjustments so necessarily difficult. Okay, so by this the factors affecting funding cost include the length of the time an assets or liability is rapid, so the liquidity term premium, so the extent to which an asset has been can be securitized, which affects its liquidity. So and the behavior of a customers, in particular product customer niches, such as a customer's propensity to withdraw long-term deposits at a penalty. So which is to repay obligation such as mortgage yearly. Okay. So by this all which affect the real funding cost. So this behavior factor complies the calculation of FTP, which has required significant and expensive changes to the banking system. Okay. So the balance sheet now incorporated new attributes for the customer and a product which were not previously significant reporting dimensions. So basically, this FTP may improve profitability through improved pricing. So which is to enhance assets liability management and provide an important component of integrated profitability reporting solutions. So as a practical example of implementing FTP, an intermediary is created within the organization. So which is usually a central office. All the fundraising unit raise funds from the market as a particular rate, lend the same to the central office at a higher rate. So all the lending units borrow the funds from the central office at a particular rate. They lend the same to the borrower at the higher rate. The central office rate is notional in a nature in aligned to your market conditions. So thus, for all the units, there are two rates available to measure the performance. So for the deposit rising unit, the difference between the interest paid to the deposit holder, interest receivable from the central office, so which is contribution to the bank's profitability. So for lending division, the difference between interest payable to the central office and interest received from the borrower is the contribution to the bank's performance. So by this, the fund transfer pricing is the way to value margin contribution from each individual loan deposit that the bank has on their books. Okay. So the way each instrument is valued by calculating funds transfer charge, the asset side loans. Okay. The funds transfer credit to the liability side deposits, loans and deposits, assets and liabilities. So the funds transfer charges and credits are calculated basis on the bank's opportunity cost of borrowing at the time of origination. Okay. So by this, the value assigned to a deposit account would be equal to the difference between cost of equivalent term borrowing less the cost that is being paid on the instrument. For example, if a bank can obtain 3-year borrowing at a 3%, so but is only paying 2% on their 3-year customer deposits, then each CD is providing, okay, CD means customer deposit, providing 1% of value each of 3 years it is open. So the net interest margin assigned to the customer's deposit would be 1% multiplied by the balance in each time of the 3 years. So the same calculation made on the loan side. For example, if a bank is say, making a 3-year fixed loan for 4% and they obtain 3-year borrowing for outside source 3%, then the loan would be providing 1% multiplied by the balance. Each of the 3-year loan is opened. Okay. So by therefore a revenue adjustment made to the bank's balance sheet to reflect cost of funds. So for example, business made which manages funds for a high net worth individuals will create cash with the held in deposits. So that deposit will accrue interest and therefore the wealth business units profits will be have to be increased by the deposit interest, which can easily be calculated by using prevailing rate of interest. So this approach became problematic during the 2007 or 8, the financial crisis, because the actual interest rates paid began to differ from the published rates, such as LIBOR, bank base rates vary. So with power credit availability, so the profit adjustment made in a favor of depositing business units were effectively understated. So this had been less of an issue when banks borrowing costs were close to base rates, so which quotes rates such as the LIBOR. So the failure to calculate FTP correctly can cause loans to be much less profitable than they initially appear. The fact that banks have extended unprofitable loans is a key factor in the recent financial crisis. So one important issue to be considered in calculating FTP is the need to value funding cost at on arm's length basis. So to understand the arm's length, one has to understand how relationship affect behavior. So conventional transfer pricing issue can be considered to explore this. So for good example, it is a father selling a home for to his son. So the value of such transfer may not be considered to be the same as what would be the achieved in open market. because similarly the business often manipulates sales of assets through intercompany trades to maximize profitability in a low tax environment. So by this, the banking terms that fact that a loan is made between a business units may reflect agreed contracted recognition of too low in the financial process. So by this, the cost rather than a prevailing actual accurate funding cost, this is both an important audit concern of a taxation interest as a transfer price affects where and which business unit is reported. So here is a simple fund transfer pricing methods of our banks. Okay. So by this transfer pricing has been an important tool for a financial institution for several decades. So this methodology was introduced to banks in early 1980s to help allocate corporate cost among business lines. Since then, the mechanism has been central to also helping allocate risk among business units. For instance, if your bank has interest rate sensitivity, what portion of the risk is driven by fee line? Mortgage, loan, deposit in this O. We took all the concepts FTP and detail how bank can use the methodology to better manage risk. So over the years, there has been a considerable debate at the community banks on how to implement the principles of FTP to various balance sheet accounts like loans, deposits through the use of proper FTP data analysis segments. So this community bank managers can realize considerable value in a product pricing incentive compensation programs. So we would like to share a recent specific loan example, the key theme FTP, okay, which is enable frontline business units to lay off interest rate risk in their loans deposits to a central treasury function. So which allows management to manage credit risk to operational risk across the business units. Then how FTP works. So this is both regulatory requirements and important tool for managing firms' balance sheet structure. Okay. So by this the measuring risk adjusted profitability. This measures interest rate risk, liquidity risk, and enables cost to be transferred from a central treasury functions to be banks, products and business lines. This is fundamentally FTP divides banks overall net interest margin into a two major submargins. So one of the deposit and one of the asset origination. So this banks can then measure economic value obtained for from each action then separately. So however, this FTP can be extended to provide other analytical tool as shown in the graph below. The graph is, so by the C, they have to maintain balance sheet management, liquidity, product pricing, profitability. So by this balance sheet management, they had to move the manage structural liquidity mismatches. Which mismatches means borrowing short to lend long, and transfer interest rate and liquidity risk to a central unit. So which is to allocate capital based on risk weighted performance parameters. So by this next one is liquidity management. For this net liquidity across the business units, fund liquidity mismatches, centralize the deployment of surplus liquidity. And the next one is profitability management, centrally measures NIM. Okay, so this control cost for fund, set targets for interest income and fee based incomes. And the next one is a product pricing. So this means incorporate risk return based product pricing. So price products based on market benchmarks, which use differential product pricings. So these are the pricing thing which has follows. Okay. So, and the next one examples of a specific example. So a few weeks ago we worked with a lender. This is an example. Okay, dollar 3B community bank who was competing for 3.2 owner. One sec. Okay, a few weeks ago they worked a lender. Okay, the dollar community bank who was competing 3.2 owner occupied commercial loan. So the lender was lamenting that the larger deal with better credit quality, his pricing was not competitive. So, however, on a smaller deals, B and C credits, okay, so he could beat the market, win most deals. So, the reason for the phenomenon the lender offered was banks' cost of funding, high relative competitions. Excuse me. So therefore, the bank could compete more effectively for higher priced loans than the tighter priced loans, in our opinion. So this is an example of a misconception of economics and the result of a lack FTP implementation. So by this, the lender ultimately lost the 3.2B, okay, owner occupied real estate loan to a competitor one 600K investment property loan. So the graph, you can go through the material which I have given. The graph is there. For examples also you can go through the material. If you have any doubts, please let me know. And the next one is the recommendations. So based on this, we recommend that community banks incorporate with FTP model to allow appropriate product pricing incentive compensation. So the March 2016, the Intergrancy Guidance on Fund Transfer Pricing outlines 4 principles related to funding. So which is contingent liquidity risk. So these are the first 1 to 4 principles. Okay. So based on this, the first principle is a firm should allocate FTP cost and benefits based on the fund risk, so on contingency liquidity risk. And the principle 2 is a firm should have a consistent, transparent FTP framework for identifying and allocating FTP cost and benefits on a timely basis and at a sufficiently granular level, so which is commensurate with the firm's size, complexity, business activities, overall risk profiles. And the principle 3 means a firm should have a robust governance structure for FTP, which including the production of a report on FTP and oversight from a senior management group and central management functions. And the principle 4 means a firm should align business incentives with a risk management and strategic objectives by incorporating FTP costs and benefits into a product pricing, business metrics, and new product approvals. So based on this, the principle 2 and 4 above are especially important in implementing an appropriate FTP framework, so which help community bank descent net interest margin. So in a manner the general ledger cannot. That this allows community the bank managers to the following. So which they needs means so understand the profit contribution of its balance sheet products, loan versus deposits, to understand the profit contribution of the channel, an officer, an organization or individual customers, so which is to create internal accountabilities of associated targets of a fund users, so which is credit risk takers and fund providers. Okay, so the price interest earnings, so products more knowledgeably based on a risk adjusted return on capital model, and the reward loan officers, branch managers and region leaders based on the margin contribution versus volume and revenue production. So by this is thing. And the next one is a needs for FTP framework. What are the needs they need to follow? They need the needs. Okay. So the first one is asset liability profile of the bank becoming more complex with the different maturities. So fixed, floating rate interest and embedded options. So the second one, the interest rate are volatile. So which changes in the interest rate affect both the current earnings and also network of the bank. And in a bank, there are simultaneously thousands of suppliers of funds and which is equally so thousands of buyers of funds. So there is no one-to-one match between the liabilities and assets of the banks. So these banks are exposed to several major risks in the course of their business. Credit risk, interest rate risk, foreign exchange risk, which we already seen in the last unit. Okay. So by this risk, a net interest margin it is called of the bank is the function of interest rate sensitivity. So which is volume mix of its earning asset and liabilities. So the interest rate risk, liquidity risk being assumed by the bank need to be taken into account when evaluating the performance and profitability of a bank. So which is faced the deregulation of interest rates and operational flexibility given to banks in pricing most of the assets and liabilities. So based on this, which require every bank to have a basis to arrive to risk balance risk based pricing for its products. So which it also important for the banks to be able to price their products in a dynamic environment of changing interest rate and liquidity situations. So by this, the interest and largest component of a bank's profits is received on loans, investments and paid on deposits. So without FTP, it would seem that all deposits generate only cost. So whereas they are source of funding necessary for giving loans. So as a consequence, the customer business units that only raise deposit funds without giving loans would be deemed unprofitable. So it's important for the bank to measure contribution of every unit, product, business to facilitate the future strategy performance evaluation. So by this FTP sets an internal price that allows estimating the cost of financing a bank and assigning it either to users of the funds. And the next one is objectives of FTP. So objectives means the aggregation of interest rate risk, liquidity risk in a central unit. So if a branch gives a fixed rate loan for 3 years and funds with a 1 year deposit at the same amount, the profitability of a branch over the next 3 years would be determined not just by credit risk assumed on the loan, so but also based on the moment of the interest rate over this period using the matched fund transfer pricing method. So this 3-year asset of the branch would be funded by the central funding unit by 3-year notable liability. Okay, so this is the way spread from the branch on its own deposits and of the branch would be matched with the notional 1-year assets to the relevant transfer pricing for the maturity, and which drive behavioral branches business units to meet overall objectives of the bank depending upon existing profile of the assets liabilities of the bank and the future business strategy of the bank. This FTP should be so structured so as to align the individual goals. So next one is a highlight peculiar aspects of a certain assets and liabilities, so which is to align incentives of a business units. Okay, so business units, and this is based on a certain assets and liabilities incentives. The business units to them a bank has obligation to lend a certain percentage of its assets to others as a priority sectors, and which is to provide a guidance for a risk-based pricing of a products at a transaction level. The pricing of the product should be reflect the cost of funding, so the operation cost and the cost of creation credit risk, embedded options, okay, which is a prepayment option, and managing liquidity. So based on this, they provide object criteria for a business unit, product performance evaluation. Volume based evaluation of a business performance is faculty simply because there is no direct correlation between volume of a basis done and profit earned. So it is possible for a bank to increase its net profit even while there is a shrinkage of its balance sheet size. And the next one is methodology. So there are different approaches of FTP which is prevalent, like pooled average cost method, so which is based on average cost of all outstanding liabilities. Okay, next one is single transfer price, which is arrived at and used for all assets and liabilities. Net transfer funds method means based on net transfer the funds difference between the assets and liabilities between the business units and funding. So on market benchmark linked method means based on a prevailing market benchmark rates different maturities. Okay, bill rate, transfer pricing curve, like that. So then matched maturity margin method means based on incremental cost of pricing the funds for a different maturities under the approach rates charged for the used for funds rates credited for providing funds are based on matching the maturity. And the next one is NIM. NIM means net interest margin. So we already seen that. So this is a different between the interest income generated and assets and amounts of interest paid for liabilities, which is relative to the amount of interest earning. So interest earning assets. The importance known as it is typically a bank's largest source of a profit, which represents 50 to 90% of a financial institutions and net income. So therefore, it is a vital to consistently and accurately measure analyze net interest margins. And the next one is why interest margin is what roles of FTP playing in NIM. Okay, so the general ledger enable you to measure the net interest margin on aggregated basis of entire institution. To understand net interest margin at the most granular level of you need to use fund transfer pricings. So based on this the components are the asset spread, so which means the net interest margin earned by fund users generated by assets such as loans, investments, fixed assets that receives an FTP change. And the liability spread means the net interest margin earned only by funds providers on a products that provide funding on institutions such as savings, checking, CDs, institution borrowings that receives FTP credit. And third one, residual spread. So which is the margin that your treasury funds management group earns by ensuring adequate liquidity and managing interest rate risk, which is exposure to the other risk. So based on this, there are three common approaches. Okay, pricing of a balance sheet includes the first one, net fund transfer pricing. So net fund transfer pricing means you net all the assets and liabilities for each profit center and ascribe a cost credit to the shortage, which is excess of funding of a branch units. So while simple implement, it has several flaws, including inability. Okay, the second one is pool based transfer pricing. So this approach, you can create a funding pool such as a short, medium, long term, assigning each product and portfolio of one of the pools. So this transfer pricing rate assigned to the pool when determine the transfer rate margin for every account in the pool. So while easy to implement and administer. And the next one is matched term transfer pricing. So this is also called matched maturity. This is the most widely accepted approach to transfer pricing. So in this term approach, you transfer price at an individual instrument, which is record level based, its characteristics such an origination date, term options, expected cash flow, which require funding desk functions. And the tool or gap analysis. Okay, gap analysis means we already seen the gap analysis in a third unit, I think so. So which is mainly asset liabilities, both the rate are sensitive in a different degree. So it is therefore to fill the gap, they need to rate sensitivity among the different group of assets and liabilities, which match identical groups of assets and liabilities. So this process gap is generally used to quantifying the rate of sensitivity of a groups, so compared to the rate of insensitivity groups of liabilities like current deposit float funds. And the next one, duration analysis. So this means under this method, the impact of a changes this market value of assets liabilities is considered. So this duration analysis is carried out with respect of each cash flow and average maturity. Then the third one is value at risk method. So this method variant of a practice market to market, which is approved securities based on the yield to maturity. And the fourth one is risk management. So under this, the risk profile of assets and liabilities are evaluated to ensure that they are within acceptable level of risk. So the availability of hedging mechanism would facilitate risk management. So this Bank of India issues specific guidelines to be followed by banks, which is managing all through the principles. Okay. So by these guidelines, RBI periodically suit the changes atmosphere to a mandatory and economic policies of the government. So by this part is over. We'll see you in next class with the next topic. Take care all. Thank you.